Very good morning, everyone. I hope you all are doing good. So, before starting the class, just 2-3 announcements. I know it's been a break in the FSR classes, but we have discussed the report, which is the most technical report released out of all the reports by RBI, right? So, financial stability report has been a very technical report, but we have tried to cover it conceptually, comprehensively. That's why it took time. Now, the remaining portion I am targeting to cover maximum in 3 parts. Okay, so far we have discussed the FSR, 7 classes have been there. Maximum I would require 3 classes more to cover this report comprehensively. Okay, so we will discuss the remaining part. Next thing, I hope you have gone through all the classes, you have gone through what we have discussed so far, all the important concepts. Also, the concepts which I have discussed with you so far, I'll not be repeating them because almost every concept I have repeated 2 and 3 times so that you get a grasp over it, right? Next thing, regarding editorial, I'm getting messages and queries regarding editorials, and the team is also getting these queries. So this is to inform you that editorials, I know we have started, we have not deliberately stopped them. The thing is that since phase 1 is approaching near, so for phase 1, other things like reports, MCQs, budget, economic survey and other MCQs, these are more relevant and important for you, right? That's why there is a pause. After phase 1, we will resume the editorial classes with full-fledged discussion, right? So then they will be useful for you in the phase 2 and the upcoming examinations. So this is the thing regarding editorial. So let's begin with the discussion. And in the last class, in the part 7, the last lecture which we have discussed, I hope we have discussed till this point before cyber risk. So we have to resume from cyber risk. Now we were discussing about the chapter 1. This is just 2-3 subheadings remaining in chapter 1. Then we'll be starting with chapter 2 today. And cyber risk is one of them. So cyber risk, if you see, the report has identified it as a key source of systemic vulnerability. As a key source of systemic vulnerability. So cyber risk is identified as a key source of systemic vulnerability in the RBI systemic risk survey. So there is a systemic risk survey which is done by RBI. Remember this thing. So who carries out the systemic risk? What is systemic risk? Systemic risk, so there are different types of risk. These kind of risks which are systemic, they are in nature that one risk can pose a threat to the entire system under one jurisdiction, right? So this is what systemic risk is. Clear? So cyber risk is one of the important source of systemic risk which can lead to collapse of the entire system under RBI systemic risk survey, which we are going to discuss further. Okay, and it was placed under high risk category in the 8 out of 10 previous half-yearly surveys. So basically, whatever surveys have been done so far, this risk, cyber risk, has been placed in high risk category. Remember this thing. Okay, cyber risk is one of the high risk categories. It poses a threat of systemic risk. Now, cyber risk incidents, if you talk about, so FSR highlights the incidents related to cyber risk. First thing, bank-wise distribution, if we see regarding cyber risk. So what have been the bank-wise distribution? 69% of the incidents, if you see, related to cyber risk, they were reported by your scheduled commercial banks. So remember, how many? 69%. 69%, okay. 69% of the incidents were reported by SCBs, 19% were reported by urban cooperative banks, UCBs, and then 12% by NBFCs. So remember, 69 by SCBs, then your 19% by UCBs, 12% by NBFCs. This is the bank-wise distribution of cyber incidents. Remember this thing. Now, if you talk about the highest share of incidents, highest share among all the incidents, it is the UCBs that had the highest share of incidents in higher risk category among all regulated entities. If you see all the regulated entities, the UCB category has the highest share of cyber incidents. Okay. So among all the regulated entities which we are talking about, this is the percentage. Remember this thing. Then if you see type of cyber incident, So among the types, the social engineering incidents, they constitute the largest share. Social engineering incidents. Now, what are social engineering incidents? We have discussed already. If you talk about the type of these risks, which type has been the major threat or has been reported more frequently? So these are social engineering incidents. What are social engineering incidents? Like phishing and all, which manipulate the customer or the individual to reveal confidential information, like phishing. Okay, so this is, so which type is the largest? Social engineering incident. Remember this thing. Incidents relating to data leakage. So these kind of incidents have been reported under social engineering. Data leakage, application security, ransomware attacks. Ransomware attacks. These are rapidly rising in the banking system. Remember this thing. Okay. Now targets. So these attackers, cyber attackers, they are targeting the data of regulated entities like KYC details, KYC related data. So it gives your confidential information related to the customers of the banks or any other related parties of the banks, their transactions, your transactions. So KYC data, KYC documents, social media related information or other platforms, they are targeting these kind of information under social engineering cyber attacks. Okay, so remember this thing. And the distribution of cyber risk. This is about the cyber risk. Next thing which we have in the chapter is financial system stress indicator. So financial system stress indicator, if we talk about, it is an indicator of the aggregate total stress at all levels in the Indian financial system. So in the entire Indian financial system, what has been the level of stress? If we talk about, the report says that it has gradually eased. Okay, so there is a gradual easing of stress during second half of 23-24. There is a gradual easing of the stress during second half of 23-24. Remember this thing. So overall financial sector stress, if you see, the indicator shows that stress has eased. If you remember the previous classes, we have seen different trends related to return on assets, return on equity of banking system, GNPA, net NPA, all these indicators, right? So if you remember GNPA, net NPA, they have fallen down. This shows that there is less of stress in the Indian financial system. Also, if you see all the regulated entities, particularly if we talk about the banks and scheduled commercial banks in particular, so CRAR or the minimum regulatory capital adequacy requirement, they are maintaining above it. Okay, so CRAR is above the minimum regulatory requirement for most of the entities. So this shows that there is a gradual easing of stress during second half of the 23-24. Remember this point. Next, the decline in stress indicator has been broad-based except for NBFCs and money market segments. So this decline has not been very significant for the NBFCs and the money market segments, but the other segments it has been very broad-based. Okay. Just remember this thing, that the decline in stress indicators has been very broad-based. Now these indicators, this information is very, very important because financial sector stress is something which we are dealing with years. Okay, so it took years to come to this downward trend of GNPA and net NPA. Now, next thing, the decline in government debt market stress. Remember this point as well. In the government debt market, if you see the government bonds, if you see long-term government bonds, their yield has been falling. So this is reducing the risk of interest, say risk related market risk, right? So these kind of risk has been reducing. The report says decline in government debt market stress is one of the primary, it is the primary contributor to improvement in overall financial sector stress indicator. Remember this point. If they ask you which is the primary contributor according to the FSR, which is the primary contributor to overall decline in the stress indicator, it has been the decline in government debt market. Okay, and why? Because of fall in the long-term yield as well as volatility and higher net portfolio debt inflows. We are also receiving net inflows. So if you see the net inflows are higher. That means we are receiving the portfolio investments, foreign portfolio investments. Now, if you remember, we have discussed this thing as well, and you all know that there's an inverse relationship between the yield and the price and the interest rate of the bond, right? So when the yield falls, that calls for rise in the prices, and that mitigates the changes or the risk which arises due to change in the interest rate, right? So it reduces the risk related to interest rate market risk. Is this clear? So this is how the decline in the government debt market has primarily contributed to less of a stress according to financial system stress indicator. This is the catch from this section. Remember the primary contributor. Okay. Now this portion is a bit technical, but you need not go into the statistics of it. You know, that is not at all relevant for you. You just need to understand the concept and then catch out the facts out of it. Okay, pick up the facts out of it. So I'll try to explain you what the main concept is. Just focus on what am I telling you in this section. It is a bit technical. Okay, so systemic risk survey. First thing is, you need to remember this survey is conducted by different central banks of the country. So in case of India, it is done by RBI, right? Systemic risk survey. I have already explained you what is a systemic risk. So the latest systemic risk survey, it was conducted in May 2024. It provides insights into the confidence level of external experts regarding the stability of Indian financial system. Broadly, if you see, why do we conduct these kind of surveys? To identify what are the systemic risk in your financial systems. Simple, right? So if you talk about India, there is a good indicator. There is a good news. What is the good news? The news is that according to these surveys and the different tools, statistical tools utilized under this survey, the stress indicator shows, or the risk indicator they show, Indian financial system is not at a higher risk, right? So even when we have tried to place higher risk scenarios or attach probable higher risk scenarios in them to assess any possibility of damage being caused by any unforeseen situation, they have stood by it. So there are figures coming in the PDF which will show that Indian financial system is at a good strength. So that is the good news. Okay. So first thing, risk assessment. Regarding the risk assessment, now there are categories. If you see across the categories, across all major risk groups, overall the risk was categorized as medium risk. So be it any kind of risk. Now when we talk about the risks associated in the financial system, there are these different kind of risks which are credit or default risk, for example, which is associated with the possibility of default on the borrowed amount. Then you have liquidity associated risk. Then you have interest related risk, which affects your interest margin, right? Then you have market risk, you have operational risk. Across the categories, they have been in the medium one. That means it is not very low, but then not very high. Okay, if managed properly, if they adhere to the compliance norms and the regulatory guidelines, even if there is a big shock, we will be able to absorb that. That is the medium category reflective of, right? So medium risk across all groups. Remember this fact. Next, but if we talk about if there is any risk which is elevated, yes. So equity price volatility risk. If there is any risk which is elevated, yes, it is equity price volatility risk. It has moved from medium to high risk category, and interest rate related risk has also increased. Now this becomes a question. Why? Because if there is any change, that becomes a probable question, be it any examination, right? So this is a general thing. Okay, we need not worry about that because they are in the medium category. But then there is a cause of worry regarding elevated risk. Okay, so remember which risk has been increased. Two risks are there: equity price related, that is related to your shares, share market, right? So equity price volatility is there. First thing, equity price volatility is there. Second thing, interest rate risk. What is interest rate risk? Due to fluctuations in the interest rate in the market, your net interest margin gets affected. This is interest rate risk, right? So these two kind of risks, they have been placed or they have moved from the medium to the higher risk category. Remember this thing, these two kind of risk, equity and interest risk. Is this clear? Right? So this is risk assessment. Then moving further, the report highlights major near-term risks. They can ask you this thing as well. If we see in the Indian financial system, what are the major near-term risks? We are not talking about the longer-term risks. What are the major near-term risks? So first is geopolitical risk, of course. There are geopolitical tensions going on. You all know that. So this is one of the near-term risks. Then tightening of global financial conditions. If you see at the global level, we have discussed this thing in the RBI annual report as well, right? If you see at the global level, the global inflation has remained above the desirable brackets. The trade volume, merchandise trade, if you remember, at the global level has shrinked, isn't it? Merchandise trade. So these conditions, they are also they also hold the capacity to affect the financial system. Then capital outflows and exchange rate pressures. Now why capital outflows? Because this is norm you have been witnessing that the major central banks, they have been adopting tight monetary policies, right? So interest rates in those countries like USA, so by Fed Reserve, have been kept higher for so long. Now in that case, capital outflow like situation happens from the emerging market and the fast developing economies like India, right? So this is the thing. And then exchange rate pressures are there. This is something we have discussed in the EMP index, if you remember, in the previous parts of this class as well, right? So these are the major near term risks highlighted by the RBI. Now, according to this survey, sustainability of credit growth, if we talk about the credit growth in the credit creation, if you see, and one trend, I hope you are able to remember, we have discussed this thing in the editorial classes as well, that there have been a divergence in the deposit growth and the credit growth, but that divergence is still in the absorption capacity or within the range which is absorbable, in the absorption capacity, right? So which can be absorbed. That means even if there is a rise in the credit growth or the credit growth is higher, that means still you are in a range, but that should not go beyond it. Otherwise, that would create risk. Why? Because if you have lesser deposits and then more credits, more loans being extended, that creates a problem, right? So sustainability of credit growth, if you see, sustainable growth is saying that according to this survey, half of the experts, they believe that increase in the credit growth witnessed in the last 2 years is somewhat sustainable. If you talk about the sustainability of this credit growth, it is somewhat sustainable. So not a very much threat to it, but then not again very sustainable, in the medium category, somewhat sustainable, right? And 27%, how many? 27% consider it to be largely sustainable, okay? So this is the thing. Then according to the survey only, systemic risk survey, some respondents or some expertise involved in this survey, they have expressed some concerns. Now what are the concerns highlighted? So there is not a big concern regarding credit growth. This is clear from this segment, right? 27% consider that credit growth in Indian financial system is largely sustainable given any unforeseen risk, right? This is the thing. Next, some respondents, they have expressed concerns like consumer loan quality. Asset quality is a concern. So if you remember the previous discussions of FSR, we have discussed the retail loans, particularly with a lesser amount. Will you tell me the amount, anyone? Particularly that smaller amount category has been reporting higher cases of delinquency or defaults. Can you tell me the amount? I'll be waiting for your answers, right? So consumer loan quality is there, then cost of funds. So basically cost of funds for the banks is rising. Why is it rising? Because interest rates, say how do the banks arrange all these funds? So you have deposits, you have repo window and MSF window and all these options from the RBI, then you have other options, you have money market instruments, all these things. So what happens is, if you remember, the repo rate is rising, right, or it has been kept higher for so long, that gives or that increases, the monetary transmission is like this, that cost of funds is rising and what the banks are earning from their assets into which they have invested, the growth is only 75, I think 75 basis points or like this. Yes, so it is going to come in the next chapter as well. We will discuss that. And then the asset quality. These are the concerns highlighted in the systemic risk survey. Consumer loan quality, cost of funds and asset quality. Remember these three concerns they have highlighted. Right? I hope this much is clear to all of you. There is no doubt so far. Now we have the chapter 2. Now we have chapter 2. Right? So chapter 2 is financial institutions, soundness and resilience. So as I told you, that section, it is not actually a bit technical. That thing is going to come in this section. Okay, so the statistical measures and standard deviation and shocks and all, they are going to come here. So this is the chapter. Now this chapter, as the heading shows, will deal with the soundness and resilience. Now soundness and resilience, for assessing the soundness and resilience of any financial entity or the system, you require certain indicators, right? So those indicators will be used to assess the resilience of the entities, and this report will tell you which entity is showing higher levels of resilience. Now in terms of banking system or financial system, what do we mean by the soundness and resilience? That means how much shock absorption capacity does the entity has if there is any kind of systemic risk of or any exaggeration or expansion of any particular type of risk, right? Okay, you are telling me the delinquency levels. I want to know the particular loan amounts in retail loans, if you remember the previous classes, which have reported highest delinquency levels. Shreya, okay? All right. So let's begin with this new chapter. First entity here to be discussed, for which we will be discussing or assessing the soundness and resilience, is the scheduled commercial banks. So your scheduled commercial banks, if you see their sectoral asset quality would mean the loans they have provided to different sectors. The loans they have provided to different sectors. So if we analyze this trend based on sectors, first thing the report says, impairment ratio in agriculture remained the highest. Remember this fact. So basically the loans provided by scheduled commercial banks in the agriculture sector or to the agriculture sector, impairment ratio in that category of loans or assets has remained the highest. Remember this thing. Now what is impairment ratio? So impairment is basically those assets which are not performing well. So impaired assets out of your total risk weighted assets or total assets, not risk weighted, impaired assets out of your total assets. Basically this is what impairment ratio tells you, right? So impairment ratio in agriculture remained the highest. Remember this thing. This is for scheduled commercial banks. Okay, but it has recorded persistent improvement since second half. Although it has remained highest, but gradually it is recording improvement. So agricultural asset quality is improving gradually. This is the catch from here, right? Next thing, the gross NPA ratio. If you see, I have already discussed what is the difference between gross and net NPA with you. I hope you remember, right? So gross NPA ratio in all categories of personal loans, it has reduced across bank groups. This is the good news. So gross NPA, if you see, for all bank groups in all categories of personal loans, it has reduced. So that shows that the burden of NPA is reducing in the banking system. Then if we talk about the industrial sector, so we have talked about the agriculture, impairment ratio is the highest. If we talk about the industrial sector, the asset quality has improved across all major subsectors. In the industrial sector, except two sectors, across all major sectors, the asset quality has improved. They are performing good. NPAs have fallen down. But there are two exceptions to this. So which are the sectors in which asset quality is not performing very well for the scheduled commercial banks? So remember these sectors. These are, so it bars the vehicles and transport equipment sector. So here the asset quality still remains a concern. Vehicles and transport equipment sector. Vehicles and transport equipment sector. Remember these two sectors, okay? Now they constitute, both the sectors, they constitute 3% share in the bank credit to industry. If you see the percentage of vehicle and transport equipment sector to the entire credit extended by scheduled commercial bank to the industrial sector, they constitute 3%. Now 3% is not a less percentage, right? If their assets are not performing well, then it is a concern. I hope this is clear to all of you. So this is regarding sectoral asset quality of scheduled commercial banks. Then if we talk about the capital adequacy, again, it's still the SCB is going on, right? So capital adequacy, if you see the second half of 23-24, the CRAR, capital to risk weighted asset ratio of the public sector banks. You all know what is CRAR by now, right? CRAR, so it is the tier 1 plus tier 2 capital divided by your total risk weighted asset. So it basically shows how much adequate capital does the bank or does the entity has to absorb the risk or any shock. Now CRAR of PSBs, if you see, so it has increased, but it has declined for private banks and foreign banks. For private banks and foreign banks. Remember this trend. So if we see the capital adequacy as highlighted by the FSR, the CRAR for public sector banks has increased. Now this is a shocking trend. Why? Why? So basically, now there is a reason and there is a consequence attached to it. Reason is PSBs have been the one of the highest contributors in the NPA, in the rising NPA when it was rising, right? But then the consequence is that now they are maintaining good amount of minimum or above what is the minimum regulatory requirement of CRAR, right? So both these sides are attached to it. So remember, the CRAR has increased for the PSBs, right? But they have declined for the private banks and for the foreign banks. Remember, declined for the private banks and the foreign banks. Then, as growth in risk-weighted assets outpace the growth in total capital for private banks and foreign banks, the system level CRAR has declined by 37 basis points during 23-24. So, this point is saying something to you. What is it saying? Growth in risk-weighted asset outpaced the growth in total capital. Why has it declined? Why has it declined for the private banks and the foreign banks? Because if you see the risk-weighted assets, they have risen. Growth in the risk-weighted assets for these banks have been higher in comparison to growth in the total capital of these banks. That's why you see the system level CRAR, it has declined by 37 basis points for them in the 23-24. Now this is the reason for the decline in CRAR. What is system level CRAR? System level CRAR, so they have contributed to a decline in the CRAR of this system. Now what is system level CRAR? System level CRAR indicates CRAR of not one individual or single entity. It indicates the CRAR of all the banks or the regulated entities, whatever concerned entities are there involved in a particular banking system under one jurisdiction, right? Okay. So remember this thing, since their CRAR has also declined, overall if you see, overall system level CRAR has declined by 37 BPS, but it is still not a concern. It is still not a concern. We will look at further in the analysis, right? So remember, system level CRAR has declined by 37 basis points. Then next, if you see the common equity tier 1, CET1 capital ratio. What is common equity tier 1 ratio? So as you all know, in the CRAR, there are two kinds of tiers, right? Tier 1, tier 2 capital. The more liquid, more trustworthy and the more important is your tier 1 capital, right? Tier 1 capital. It involves your common equity of the bank, their retained earnings, etc., apart from other components, right? So, what is CET1 capital ratio? It is common equity tier 1 capital ratio to the risk weighted assets, total risk weighted assets. So, here we are only talking about the components of tier 1 and not the tier 2. Simple. Now, this term is going to come very frequently in the further PDF. So, remember, that's why I have explained you what is CET1. So, the ratio of tier 1 capital, particularly common equity, if you see, of the banks and the retained holdings, their retained earnings, as a ratio of the total risk weighted assets, right? Now, this is indicative of strength because this is more important, more liquid, and more it contributes more to the strengthening of the financial system and reduces the risk if there is any, right? So, this is important. So, the common equity tier 1 capital ratio, it inched closer to its record level of March 2023 as its share in total capital has increased. So, if you see the scheduled commercial banks CET1 capital ratio, it has increased. Now, this is a good indicator. Remember, I am also trying to explain you these trends, which trend is good, which is bad, so that you understand these things, what are happening. It's not like you just remember this has increased, this has fallen down, right? So, that's why I keep on telling you, okay, this is a good indicator. So, as to make you understand that this is something contributing to the betterment of the system, right? So, CET1 ratio has increased for the SCBs, remember this thing. Next. So, if you see this graph, this line peach color, right? Fallen down, then increase, then fall down, but now continuously increasing, right? This is CET1 in total ratio. It has increased. Now, when we talk about the banking system resilience of SCBs, again resilience means what? Their shock absorbing capacity. So, SCBs in India, they are mandated to maintain a minimum CRAR of 9%. You all know that, right? So, these CRAR requirements, they are given by your Basel Accords or Basel norms, Basel 1, 2, 3, right? But RBI has provided this for SCBs to be at 9%. So, this is minimum regulatory requirement on an ongoing basis. Now, to ensure viability and smooth business functioning. Since 2009, the bank group level CRARs, they have been remained much above the regulatory minimum. Now, this is the trend you can remember to eliminate the options in the questions if they try to confuse you, right? So, remember at the bank group level, not only SCBs, other banks as well, their CRAR has been, they have been able to maintain the CRAR above the minimum regulatory. That is a sign of strength and resilience of the system, isn't it? Right? So, remember this thing. The lowest CRARs among the PSBs, private banks, foreign banks, which was observed during this period, it was 11.2, 15% and 14.3 respectively, which is lowest but still higher than the minimum regulatory requirement. So, this is the thing. Now, remember these CRAR percentages respectively. So, for PSBs, lowest what have been observed during this period of assessment. For PSBs, lowest was 11.2. For private, lowest was 15. Now, you see CRAR has been 11.2 for PSBs, 15% for private banks and 14.3 for foreign banks, right? But still, they are able to maintain it above the minimum regulatory norm. Among bank groups, the maximum resilience is displayed by foreign banks. Now, if they ask you regarding maximum resilience which has been displayed, so this is by foreign banks. Foreign banks, they are having good strength to deal with any kind of risk or unforeseen situation, right? So, this is the thing. With improvement in the asset quality and capital adequacy, PSBs have also displayed better convergence than PVBs and also showed the highest resilient among bank groups in the latest quarter. So, across bank groups, in this entire period, if they ask you, will be by foreign banks. If they ask you highest resilient among bank groups in the latest quarter assessed for this purpose will be public sector banks, because their asset quality has improved. So PSBs have, if you compare public sector banks with private banks, they have performed well, right? Now this is a good sign, because these were one of the important contributors, or not important, but largest contributors to the rising gross NPA levels, right? But now they are performing well. That is a good indicator, right? So this was regarding banking system resilience. Now if you see the earnings and profitability, if we talk about the earnings and profitability, so still scheduled commercial banks are going on, right? Earnings and profitability. Net interest income, if you see, net interest income of these scheduled commercial bank, it has increased. So earning we are talking about. Profitability indicators are something we have already seen, right? So tell me quickly, in the profitability indicators, these banks have performed well or bad? In the previous classes, if you remember the previous classes, tell me. No, here the foreign banks are foreign branches of Indian banks. Here the foreign banks are Indian branches of the foreign banks, okay? So profitability, do you remember? They have performed well on the profitability indicators. Net interest income. What is net interest income? Net of interest income, basically. So now remember, these two concepts are different, right? There is a difference in net interest margin and net interest income. Net interest margin is the difference between what the bank charges to you on the loan amount and what it offers you on the deposit. Net interest income is what the difference between what the bank is offering you on its financial liabilities or any of the instruments, financial instruments, and what is it earning out of the assets, financial assets. So this is not primarily about the loans. It includes all other financial assets. Clear? Right? So this is net interest income. So if you see the net interest income as an indicator of the earnings for SCBs, it has increased. That is a good sign. Okay, with a surge in trading income, and particularly if they ask you why this increase has been there in the net interest income for SCBs, the primary contributor is increase in trading income, which has augmented the other operating income category of SCBs. Now what is trading income? Trading income basically means the income which you generate when there is a sale and purchase of these financial assets. Is this clear? What is trading income? Right? So this trading income and all other kind of income, whatever income the bank is generating apart from the core banking operations, is categorized under your other operating income category. I hope these concepts and the trend is clear to all of you. Right? So net interest income increased due to rise in trading income, which is the income generated due to sale and purchase of the financial assets, and which is placed under the other operating income category, which is income generated from apart from the core banking sources. So if you see the net interest income, the orange part, has expanded continuously from this to this. It was this much and then it has expanded to this much. If you see this composition, it has increased net interest income. Okay. And then if you see other operating income is also increasing. Now this is a good indicator. Other operating income is also increasing. That means banks are not dependent solely on the core banking sources of income or core banking functions for their earnings. This is another trend you can remember from here. See, I have explained you the difference between net interest margin and net interest income. Net interest margin is particularly related to your core banking solutions or core banking operations. So this is the spread which is the earning of the bank. So bank charges higher on the loan provided, the interest rate, and gives you lesser on the deposit which you make, right? This is net interest margin. But when we talk about the net interest income, it is beyond core banking functions. All the financial assets which the bank provides you for investment and bank does the investment into. So the difference in the interest, what has been given by the bank to the investors and what or customers or what has the bank has earned on those financial assets is your net interest income. I hope this is clear now. Okay. Then if you see further, so it tells that the profit after tax has also rose. So as the need for additional provisions fell due to depleting stock of NPAs. Now what are provisions? You all know provisions. So we need to keep a certain amount of the capital or the asset for mitigating any kind of risk. But since NPAs have been on a continuous decline, gross NPA and net NPA, the requirement of additional provisioning has been reduced. So now those funds they are addition. So now banks have profit after tax. So whatever taxation liability is deducted, so PAT, profit after tax, it has rose for the banks because of these declining NP. Now you need not keep more under the provisions or as provisions against NPA. So that has led to rise in PAT or profit after tax for scheduled commercial banks by 32.5% if seen on year basis, right? In spite of large increase in the operating expenses rising, still you see PAT, profit after tax, expanding for the scheduled commercial banks, right? I hope you have understood this point. Then on the back of significant increase in net interest income and other operating income, the private banks, they registered higher PAT growth in relation to PSB. Now there is a divergence in the trend. You see, in terms of CRAR and resilience, PSBs have performed well than the private banks, right? But if you see NII, net interest income and other operating income category, the private banks, they have registered higher profits after tax as compared to PSBs. Clear? Now, so this is something I was discussing with you, that lagged effects of transmission of monetary policy rate increases and shifts in liquidity conditions, they have led to 100 basis points rise in the cost of funds as against 75 basis points rise in the yield on assets. Now this is something you have to remember. Remember both the figures. 100 basis points rise in the cost of funds for scheduled commercial banks and 75 basis points rise in their yield on the assets. Now what is this thing and what is the reason? So you see, there is a concept of monetary transmission, right? There is a concept of monetary transmission, that the decisions taken by the Monetary Policy Committee regarding the key policy rate, as and when they are required to meet, right, they get transmitted to the economy gradually. It's not like today they have decided to keep policy rate at 6.5% and then tomorrow it gets translated to all the customers in the banking system via the financial system, right? It is not like this. So it takes time. Now due to these lag in the monetary transmission, there has been increase and shifts in liquidity conditions. So it has affected the liquidity conditions of the banking system. This has led to this divergence in these two figures. There has been 100 basis points rise in the cost of funds, because now repo rate has increased. So you know, repo rate is a cost of fund for the bank, yes or no? What is cost of fund? The interest you pay when you borrow something, isn't it? Right? To arrange fund, what you have to pay is the cost. Simple. So my question to you is rising repo rate, for example, isn't it a cost of fund for the bank? Tell me, yes or no? Or whichever eligible entity is there to borrow under repo window. Yes or no? Anyone? Yes or no? No answers? Yes, right? Absolutely. So this rise in the cost of funds, now if there is rise in cost of fund, so that is the thing. Why? Because it is something which transmits quickly. If there is rise in repo rate, you have the rise in the cost of funds. But to translate it to the people via the monetary transmission to the economy, that takes time. So the earnings or the 75% basis 75 basis points, not percent, rise in the yield of assets has been the gap. Banks have not been able to reap out of these monetary transmission very quickly, but the cost of funds has risen very quickly. Now if you could relate, in that survey, if you remember, today only we have discussed, experts have highlighted a concern regarding cost of funds. Do you relate to this, right? Do you remember the initial discussion of today's class only? So this is why there is a concern. Now I hope you have understood all these things. So remember, 100 basis point rise in the cost of fund and 75 basis point rise on their yield on the assets. Now as a result, net interest margin, now the concept is different, net interest margin. So that's why net interest margin? Because if your cost of funds has risen, so net interest margin of SABs has shrunk, right? You will charge higher, and if you charge higher, you will have to pay higher as well on the deposits, right? So net interest margin of the SABs, it has shrunk marginally, right? And then profitability of banks, if you talk, so this is about the earnings. Profitability, if we talk about, has remained high. So this is something we have already discussed. The profitability has remained high. We have discussed the indicators like return on assets and return on equity and return on assets in the very first class, right? So this is regarding earning and profitability. I hope this section is clear for SCBs. Then we talk about the resilience. Now this is the most technical part so far we have discussed. So resilience के लिए we have a macro stress test. Resilience के लिए we have a macro stress test. What is resilience? How much capacity you have for mitigating any kind of risk. Simple. Macro stress tests, they are done. So there are different statistical measures and tools and metrics used to do this test. So basically, what is macro stress test? So it is performed to assess the resilience of the SCB's balance sheet to unforeseen shocks emanating from macroeconomic environment. Due to any macroeconomic environment. Now macroeconomic changes can be of, say, changes in the GDP, decline in GDP, rise in inflation, whatever your macroeconomic indicators are. Due to any of the change in the macroeconomic indicator, what can be the shock or risk to the balance sheet of these SCBs? This is what macro stress test indicates, right? Now, what is the methodology used? So, remember the methodology as well. Methodology is to assess capital ratios. So, you assess the capital ratio, how much capital do you hold against your risk weighted assets on a 1 year horizon. So, one year period basically broadly, right, under a baseline and two adverse scenarios. So remember one thing here, the language is a bit technical and cliche, but I am trying to make it easy as much as possible. So listen carefully. Listen carefully. So this is 1 year period basis and it is done on a baseline and two adverse scenario. Now what are baseline and adverse scenarios? Baseline scenario says how much is the anticipated impact, okay, forecasted values. So we try to forecast that, okay, if say macroeconomic variables, they go in this direction, how much will be the anticipated risk? Simple baseline scenario. Is this clear to all of you, right? So please reply quickly so that I know you are getting all these technicalities. This is baseline. Now there are two adverse scenarios. So in these adverse scenarios, we try to assess the resilience. What can be the most adverse scenario? And in these adverse scenarios, how much resilient you are? What is the capital ratio you hold to deal with these adverse scenarios? Now what are these two adverse scenarios? So there are two adverse scenarios here, right? The medium and the severe adverse scenarios. Medium and the severe adverse scenarios. So these are arrived by applying. Now we apply the shock. Now what is shock and standard deviation? Shock and standard deviation. You know, in statistics, standard deviation applied to a set of values tells you the variation or the dispersion, isn't it, in those values or set of values? Yes or no? Right? So standard deviation is this. Then what is shock? So we try to assess the impact of any shock. So we try to give this value. Now for medium scenario, it is applied 0.25 to 1 standard deviation, the value applied shock, and 1.25 to 2 standard deviation shocks respectively. For medium, it is 0.25 to 1 standard deviation, and for severe situations, it is 1.25 to 2 SD shocks or 2 standard deviation shocks. Just remember this thing. It is a bit technical, they'll not ask you these kind of questions, but it is the thing. So this is how they try to assess the adverse scenarios, right? Baseline is simple, the anticipated one. In the medium one, you try to assess the medium risk or risk of any shock or any shock which impacts you in a medium range or adversity. But then you have severe adversity which can be there. This is how they both are calculated, okay? So you apply 0.25 to 1 standard deviation to the macroeconomic variables and 1.25 to 2 standard deviations to assess the impact of these changes in the macroeconomic variables. Now remember one thing as well, why do we increase these shocks? As we increase these shocks, if you see 0.25 for medium situation, medium risk, and 1.25 shock applied to 2 standard deviations is for severe adversity. So increasing it gradually tells you if there is increase in the severity of any risk, how much your banking entity or financial entity or regulated entity will be in a position to deal with it, right? So it is increased gradually or sequentially by 25 basis points in each quarter of the stress test. So we do not increase these values of shocks in one go, right? We try to increase them in the stress test gradually or sequentially. Then we try to assess their severity. I hope this much is clear. You need not go in the statistics of it, that is not at all relevant, but this much is also beyond relevance, but still you should understand what is given in the report. That's why I have tried to. How do we apply would require an entire lecture to tell you how standard deviation is calculated, how these shocks are applied, and then what is the result is of no use of discussion for this examination or any regulatory body examination, right? So this much is relevant and this is more than enough what I have explained to you. Clear? Now, so this is the methodology, not important, but then we are concerned with the results, okay? We are concerned with the results. What are the results? So this macro stress test result is first for scheduled commercial banks. All these tests done, they show that SCBs are well capitalized, they have good amount of capital and they are capable of absorbing macroeconomic shocks even in absence of any further capital infusion by stakeholders. So this is the level of resilience which the scheduled commercial banks hold. This is the thing, right? So they have good amount of capital. If there is no further infusion of capital done by the stakeholders, still they will be able to absorb macroeconomic shocks, right? This is the thing. Now under the baseline scenario, so different scenarios, if you see the baseline scenario, the anticipated risks, the aggregate CRAR of 46 major banks, if you see 46 major banks, it is projected to slip from 16.7% in March 24 to 16.1% only by March 2025. So the report is saying that according to the baseline scenario methodology used in the macro stress test, even if you take the 46 major banks of the system, the aggregate CRAR according to the baseline scenario based risks identified or anticipated or forecasted, the CRAR of 46 major banks is expected only to decline from 16.7% to 16.1% by March 2025 if it happens. So this is the safety or resilience level which we hold. Is it clear? Right? Just remember this thing. Next. Now, it may go down to 14.4% in the medium stress scenario. So, CRAR of 46 major banks, right? CRAR of 46 major banks. Baseline scenario में सिर्फ इतना ही कम होगा. But if you see medium stress, if there is, what is the severity of the stress? Medium stress, right? According to the methodology. In medium, it may go down to 14.4% in medium stress scenario and to 13% under severe stress. If there is any macroeconomic condition which poses or which results into severe stress on the financial system, then also it will go down only to 13%. Now, these will still be above than the minimum, above the minimum capital requirement, which is 9%. Isn't it? So, still you see, I hope you are getting how much resilient these are, right? So, minimum regulatory requirement is 9%. Even if the medium and the severe case, they will be declining to 14 or 13% respectively, which is still far beyond the minimum regulatory requirement of 9%. So, banking systems are very resilient. Now, see, since you have understood the concept, now you are able to get these trends. So, in that case, that's why it takes time. But then I try to explain you the concepts and then the facts. If they ask you something related in the descriptive as well, you will be in a position to write these things, or they ask you in the interview, you will not be like, okay, blank faces. Figures to yaad the, but unka implications nahi pata, right? But now you know, what do these numbers tell to you, right? So it takes time, but then do something religiously if you are doing it. Otherwise, don't do it. This is my philosophy, right? So this is the thing. Now, next thing, no SCBs would breach the minimum capital requirement of 9% over a year and ahead horizon. So, according to this macro stress test, SCBs are very much resilient, be it baseline scenario, be it medium risk category, be it adverse risk category, no SCB will breach this minimum regulatory requirement, right? So, they are that much resilient and sound. Then this was about CRAR. If you see the CET1 capital ratio, of again 46 selected SCBs, major banks in the group, they may decline from 13.8% to 13.4% under baseline scenario, CET1 capital, right? Even in medium stress and severe stress, it might deplete by only 300 basis points. Right? Again, that decline would not breach the minimum regulatory norms. All banks would be able to meet the minimum CET1 ratio of 5.5%. Remember this figure. What is minimum CET1 requirement for all the banks or all the scheduled commercial banks? It is 5.5%. This is something you get a direct question from here. What is the minimum CET1 ratio requirement? 5.5%. 5.5%. Clear? Right? Still, they will be way beyond this minimum requirement. So, again, above the minimum regulatory requirement in CRAR, and then again, above the minimum regulatory requirement for CET1 capital ratio. That is a good indicator, indeed, right? Now, if we talk about the GNPA ratio, GNPA ratio, gross NPA. So according to the macro stress test, gross NPA ratio of all the SCBs, it may improve to 2.5% under the baseline scenario, right? However, if the macroeconomic environment worsens to a severe stress scenario even, the ratio may rise to 3.4%. So we are saying, what about the gross NPA? Under baseline scenario, it might increase to 2.5%. Even if there is a severe stress, macroeconomic stress, it may rise only, say, up to 3.4%. So again, it is not very high. So in terms of GNPA as well, we are resilient. Okay. Then under the severe stress scenario, particularly if you see the categorization, now this categorization becomes important. Under severe stress scenario, what will be or what do we expect on account of GNPA for PSBs, private banks and foreign banks is this. So the GNPA ratio of public sector banks, it might increase from 3.7 to 4.1, okay, while it may go up from 1.2 to 2.8 for private banks and from 1.2 to just 1.3 for foreign banks. Now tell me, on the basis of these three categories, under severe stress scenario we are talking, not the medium stress, which one shows the most resilience? That's why we have discussed that FBs among all the bank groups have been at the highest level of resilience. Which one is more resilient? Tell me. Across these three categories, if you see the expected rise in the GNPA in severe stress scenario, tell me quickly, which one is reflecting higher degree of resilience? Very good. So you are answering, that shows you are getting the concept, right? Very good, very good. So now you understand all the thing. You need not mug up each and every minute fact. If you understand the broader trend, you are in a position to at least eliminate the options, right? So this was the macro stress test indicator, and remaining, not much is remaining now in this report. Remaining portions will be covered in the next class and the next class. So we will resume from sensitivity analysis. This was a bit technical. I hope you are able to understand. I try to make it simpler as much as possible, right? So we will resume from sensitivity analysis. Please keep on revising these concepts, trends and the figures, and whatever is highlighted and whatever I have asked you to remember is important, right? There is nothing like ideal GNPA, but it should be lower, right? It should be lower. Ideally तो NPA होना ही नहीं चाहिए. Getting my point? But still you cannot eliminate NPA. It should be lower on a declining trend. Simple. Any doubts from today's class, or shall we end this session here? Otherwise it will be too long, right, for you to revise the concepts in the class. But then go to all these classes with the highest speed, right, so that you can revise them quickly. Any doubts? All right. So I hope no doubts are there. As I told you, as I told you in the initial class only, maximum I would require after 7. So today it has been completed. So two more parts I think, and the FSR will be done. Okay. I'll try to cover it only in the 2 more parts. हाँ जल्दी हो जाएगा. I think day after tomorrow तक it will be done. Okay. Don't worry about that. See, just a simple question to all of you. I understand your concern that you have lesser time and you need to revise a lot. But just a question, you can go through these figures, through these reports or not on your own, okay? There will be no point of taking these classes if I tell you that this has risen, this has fallen, this has risen. That way I can complete the entire FSR in 1 hour. and it will be easier for you to go through 1 hour class, but it will be of no use, right? So that's why it takes time, but then you prepare it to the level, highest level which you can appear, so the interview level, right? Yeah, this much is more than sufficient, more than sufficient. If you are able to remember what we have discussed in the class, believe me, you will do wonders in the exam, right? Whatever is being provided to you on these classes and the content, if you have given your 100% even to this thing, so your input cost to benefit analysis, if you do, your outputs will be high. Okay, anything else? All right then, so you have copied my tagline, right? Thank you so much. Have a great day. You too have a great day. And then we will meet tomorrow with the next part of the FSR. Keep come after revising all these things, you will be able to relate the further concepts. How should we jot down effectively for a week before the exam? So try to give your time to the most important things and to those things which you think the input output ratio will be good, right? So for example, going through PDFs in the end or before, just 1 week before the examination will not be of use. Go through the MCQs. This is the hint I am giving you, right? So this is how you can go. And for the figures, you can write down in a comparison in a chart where you compare all these things, because when you do comparison, you are able to retain the numbers for a longer period of time. So you can make your revision notes like this, comparing the tables. The CRAR for this, ऐसे एक एक करके बस figure लिख लिया. उससे you will be able to retain all these concepts and go with the summaries and the MCQs for the revision part. This is the thing. Okay. All right then. Thank you so much. I'll see you in the next class. Have a good day. Thank you.